7 Ways Billionaires Avoid Tax on a Massive Scale. The former world's richest man and multimillionaire, Jeff Bezos, did not pay federal income taxes in 2007. In 2011, he once again received payment. Elon Musk, the creator of Tesla and the current richest man in the world, paid no federal income taxes in 2018. In recent years, Michael Bloomberg was able to accomplish the same. Welcome back to another exciting video. Today's video is about 7 ways billionaires avoid tax on a massive scale. Before we start the video, please like, subscribe, and press the bell icon. Put it in the freezer. Transferring important assets to other people, such as your children, is possible by freezing trusts without incurring federal estate tax. The plan is not overly complicated. The wealthy simply depreciate their assets many years before passing them on to avoid estate taxes and asset appreciation. One of the most popular strategies in business is exchanging common stocks for preferred equities. When you exchange your common stock for preferred stock, you are relieved of the capital gains tax you would otherwise be required to pay when you sold your common shares for cash. The following stage is to place some preferred shares in a trust and rely on the dividends to support yourself. Charitable donations. Donations to charities are not tax deductible. Because of this, every affluent person has some form of foundation. Rich people have always used charitable contributions to qualify for tax deductions, and this practice will continue under the new tax code. Your deduction limit has increased from 50% to 60% of your adjusted gross income. Conservation easements are one way the wealthy have taken advantage of the deduction. A large piece of land might be worth something on its own. Perhaps it is located on a migratory bird field. Perhaps there is a river there, or perhaps there is some green space in an overdeveloped region. Working with land conservation trusts frequently entitles you to a charitable deduction for the cost of the conservation easement you erect on the land. Managing assets like a business. Rich people can reduce their tax burden by managing their investments through a structure like a limited liability company, LLC. It could consist of a business, real estate, or portfolio assets. There are many ways to cut costs while setting up a governance framework for their assets. However, it may get complicated. Under certain conditions, the expenses incurred by the LLC will be deductible as business expenses if the LLC is a management firm that offers guidance and oversight to owners of the assets. Send it overseas. If you keep up with the news, you must be aware of the Pandora Papers. 11.9 million of these papers were leaked, 14 firms with 2.9 gigabytes of data from offshore tax havens. You were revealing the true owners of offshore businesses, hidden bank accounts, private planes, yachts, mansions, and works of art by Banksy and Picasso. It made billionaires, politicians, and international leaders' hidden money and business dealings public. The Panama Papers, which revealed the financial and client attorney information of over 214,488 offshore entities established by the Panamanian legal firm Mossack Fonseca to cheat taxes, came before that. But not all millionaires or wealthy people engage in dubious business dealings to conceal their income. Some simply register their enterprises or deposit money in accounts in nations with lower tax rates. Asset-backed lending. In 2021. In March, billionaire hedge fund manager Alan Howard purchased a Manhattan mansion valued at $59 million. He secured a $30 million mortgage from Citigroup Incorporated. Only 2 months later. Similar year. Due to his shares and promise to invest in an electric vehicle business, Denny has overcome his $6.1 billion hurdle. Edgar and Clarissa Bronfman will use a portion of that equity to secure a credit line from the same bank. Damien Hirst and Diego Rivera paintings, among others, are used as loan collateral. In the meantime, Philippe Lafon pledged shares in a dozen funds and his Kodo management to J.P. Morgan Chase and Company for a credit line. It enables the wealthy to borrow money against their portfolio when they need cash, eliminating the need to sell appreciated investments that may result in gains. Additionally, the portfolio loan is not taxable or reported on a tax return, unlike the most popular strategy banks use when lending to simply affluent clients, which uses public equities as collateral. Richer people typically have a variety of assets they may realistically use as collateral, including houses, planes, and even more obscure rarities like watches and vintage vehicles. They choose whole life insurance. Buying whole life insurance, which, as the name implies, lasts for the policyholder's whole life, is another especially advantageous method for wealthy taxpayers. Because it also has an investment component, it is noted on the list that many financial advisors do not advise the average person to purchase whole life insurance. Instead, term life insurance, which does not include an investment component and covers a policyholder for a predetermined period, is preferred by many experts. For instance, it will be 30 years before their dependent children are old enough to support themselves. Buying art. Media coverage of the art market is increasing as more people become aware of how dubious the industry is. This is not surprising because it is the last significant unregulated market. Because of this, it's a fantastic area for the wealthy to get away from the tax collectors. Consider a scenario in which Mr. Hay makes $1 million a year and decides to spend it all on a $1 million artwork. Similar to the artwork of 3 individuals on display in the gallery as part of the exhibition titled "The World as Non-Objectivity." 3 years later, nothing is left over to be taxed because the purchase expense equals the revenue. The value of the same picture has increased. It may now be worth $6 million or less, depending on the professional appraiser's opinion. Mr. Hay decides to donate it to a museum or an art foundation instead of selling it for profit. Assuming Mr. Hay continues to make $1 million annually, this translates to an extra $5 million in non-taxable income, making it easy for the wealthy to benefit from Mr. Hay's $6 million tax deduction. Thanks for watching the video. If you enjoyed it, please like, share, and subscribe to our channel for more exciting content.